Okay, so you've decided to buy real estate for an investment. Now, what kind of property do you choose to buy? For me and a lot of other people I know, if you have to choose only one type of property, I would choose apartments. Now, other options you might consider would be vacant land, single-family homes, and single-tenant office or commercial buildings. Apartments, also known as multifamily properties, offer a huge advantage over vacant land. They provide monthly income while you own them, while vacant land does not. If you compare apartments to single-family homes, you'll see there are several advantages in favor of apartments. And here we're specifically talking about 5 apartment units or larger. In addition to providing monthly cash flow, an apartment property will, first, spread the risk. With single-family homes, if your tenant moves out or doesn't pay, you can't cover the mortgage payment that month. With apartments, even if one tenant moves out, you have other tenants paying rent, so the mortgage and other expenses are paid. Second, apartments leverage your time. Larger properties make it feasible for you to hire a manager to handle the day-to-day operations of the property. You can then spend your time finding more apartments to buy. Third, apartments leverage your money. You can buy more units for the same down payment than with single-family properties. And fourth, apartments are a hedge against inflation. As inflation comes into play, you can always raise the rents to be sure your income from the property keeps pace with inflation. You can't always do that with commercial or industrial property. And finally, apartments take advantage of economies of scale. If you have 8 single-family homes, you have 8 buildings, 8 roofs, and 8 yards to maintain scattered all across town. With one 8-unit apartment building, you have 1 roof, 1 building, 1 yard to maintain, all in one location. Now, there are 3 ways apartments actually pay you. First, apartments pay you when you buy them. You can negotiate for the seller to pay you for the deferred maintenance that he hasn't completed. This is called a repair allowance. This puts cash in your pocket to make those repairs as soon as you own the property. Second, you can find properties that have owner problems, and the owner is willing to sell the property to you well below market value if you can take action quickly. Third, if you find the deal, organize the investors, and get it closed, you can collect an acquisition fee at closing equal to 3 to 5% of the purchase price of that property. Apartments also pay you while you own them. Of course, everyone knows rents pay the mortgage. But rents also cover the expenses of owning and maintaining the property and put money in your pocket each month. Tenants, on the other hand, can provide you with other income from things like laundry rooms with coin-operated washers and dryers, and you can negotiate exclusive cable and TV and internet service rights so that those companies pay you for the exclusive right to serve your tenants. And finally, you can implement a utility bill-back system that helps the tenants pay their pro rata share of the water bill or garbage service each month. And finally, the IRS also allows you with accelerated depreciation, which affects your net income from the property, reducing the taxes you pay on that income every year. So finally, apartments pay you when you sell. You recapture your equity and the additional equity you've created due to increases in the net operating income of the property. Now I'll leave you with these 2 parting thoughts. First, you'll discover that banks prefer to make loans on apartments over any other type of real estate. And second, when you understand the process, it's almost as easy to negotiate the purchase of one apartment property as it is to negotiate the purchase of one single-family home. I'm Jim Grier with the Champion Capital Alliance, and we want to help your family create financial security for generations to come.